Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a daily candle chart of the Qs. It's the QQQ Trust. It's basically the ETF that represents the tech sector. And as I do each and every week, I've left my lines on the chart so you can see how the forecast worked out. And it worked out quite nicely this week. You can see that my forecast lines for 2 weeks in a row hit right on the money. And now what we have is a hammer pattern. See that? That hammer pattern is bullish. We have a long shadow underneath that hammer, and that tells us that at one point during the day, the sellers were able to push it down to a new low, but by the end of the day, the buyers came back with force, and that's why that's taken as a bullish candle. If you take a look at a textbook example of what the hammer looks like, you can see here, long shadow. Again, the shadow needs to be 1.5 to 2 times the length of the body. The color of the candle doesn't really matter that much, but the fact that it is shown at the end of a downward leg does make a difference, and that's why 80% of the time when you see a hammer pattern, it generally results in a rally after that. Now, let's not get crazy here. I'm not getting extremely bullish, but I am going to be more bullish for next week because of what's happening on the chart. As I zoom in here, you'll see that we have the moving average still heading lower right there. So what I expect to see happen next week is I believe that the buyers will continue to push this up, and there's a small little gap right here. See that gap? Now that is going to fill 80% of the time. Most gaps do. Once the gap fills, there's now an 80% chance that the price will drop from that point. Now, while this is going on, you'll see that the moving average is still heading lower because the price is literally drawing it to the lower level. And what I believe is going to happen is that once this was support, it has now broken below it, and now the former support turns to resistance, and I think that moving average is going to continue to act as resistance. So while I will draw my forecast line to the upside, it's going to stop right at the gap fill point right here, and then we'll have to see whether or not the buyers continue to push it up because there's still another gap above the market here. So my price target for next week on the Qs through the QQQ is basically 318.14, so mark that and we'll see how that works out. If we look at the IWM, this is more or less the Russell 2000 representing the small caps, and you can see as I zoom in here, target was hit perfectly, hit the support level, and guess what? Another hammer pattern. This one too, I think we're going to see a move higher, and that 20-period moving average will, again, most likely act as resistance. So if you're a short-term buyer looking to take some quick profits, I would strongly encourage that you trail your stops up as the price moves higher. That way you can protect your profits without adding any more risk to your account. Now, if the market starts dropping below these former support levels here and here, I would have to say risk management is going to be critical for you at that point, because if we see a breakdown in these support levels, take a look at where the monthly chart could lead us here. Again, the IWM is still showing extremely overbought condition, and this is very close to a hanging man on the monthly chart. Now, again, this is a monthly chart. This is why I'm not madly bullish. In fact, long term, I'm still holding my bearish stance because we have such a wide divergence from this moving average, which is now the 20-month moving average. And you can see the oscillators down here are still moving lower. So again, while I'm going to be short-term bullish for next week, I'm going to quickly advise that any pullback from that moving average is going to switch the tide very quickly to the downside. And again, we'll have to manage risk at those points. Now, if we look at the diamonds, ticker symbol DIA, representing the Dow Jones Industrial Average ETF, came very close to hitting that target. Again, this is a long shadow candle. We see that there is resistance up at the top. I'm not too crazy about a breakout over that line, but I'm going to say we're going to move up and then start to pull back. My upside price target next week for the diamonds is 318.10. Very similar to what I'm talking about with the Qs and the Russell. That will most likely have resistance hit, at which point the sellers will most likely take some short-term profits. If we see a breakout, then what do? You trail your stops up. That's what you do. Traders learn how to protect themselves on the way down, but they also know how to protect their profits on the way up. So I do strongly recommend that you learn how to trail your stops in the direction of where the price is moving. Now, last week, I did not analyze the spiders because I was talking about silver. I'm still bullish on silver. Didn't come all the way down on my 2-week target, but I'm going to hold that one as a support level. Short term on the spiders, I do believe we're going to go back up to test that resistance right here. That resistance is up there very close to, what is that, 395.07, but my price target on the spiders is 390.58. $390.58 on that one, mainly because this resistance right here has been tested many times, and in the past, not too long ago, the volume was dropping as it was hitting that resistance. You see here the big volume drop at the end of last week and the beginning of this week. So that volume drop, and this 20-period moving average is also going to act as resistance. So pretty much putting my price target just around these highs right here. Keep an eye on that. Again, trail your stop up. If you look at the VIX, came close to hitting my upside target on that. VIX came out with a bearish engulfing pattern today. So I'm still going to keep this target here as the way it is, up around 33. But I'm going to adjust this because of the bearish engulfing pattern. Bearish engulfing patterns generally result in downside moves about 80% of the time. I think we will go down, hit that moving average, and then I think we're going to make another round. Again, right around 33 is my price target for the VIX. Notice how the oscillators are kind of stuck right in the middle here of this range. All right, so that support level at the moving average will be another test for the market if we fail to get down below that or bounce off of it. Again, because for the most part, the VIX is inversely related to the S&P, so if we get another bounce to the upside, that's going to be bearish for the S&P. I'd like to thank each and every one of you for following and subscribing. Please continue to promote that. It helps us get the word out, helps promote technical analysis, not just as a forecasting tool, but as a risk management tool. So when you share this, you're helping other people learn how to trade and follow the charts. And it really, the best thing about charting is that it helps you remove the emotions from that decision-making process. And when you could pull the emotions out of the equation, you're increasing your chances of making money, and you're increasing the probability with regard to your forecasting and the percentage of accuracy. So again, thank you so much. Hit the notification bell if you'd like to get notified when this alert goes out, and we'll talk to you next week. So long.